Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Precedent Transactions Analysis, a complete guide for beginners. Analyzing transaction metrics. Now that you have the data, it's time to break it down into actionable insights. This part of the process focuses on evaluating valuation multiples and understanding what drove the deal pricing. Here's how to approach it. Compare valuation multiples. Focus on metrics like EV, EBITDA, EV, revenue, or P/E. Identify the range and averages across your data set to establish benchmarks. Adjust for deal-specific factors. Not every deal is directly comparable, so adjust for differences like control premiums, synergies, and economic conditions at the time of the transaction. Identify trends. Look for patterns in valuation. For example, do companies in a particular industry command higher multiples? Are certain payment structures, e.g., all-cash deals, linked to premium pricing? Outlier review. If a transaction has unusually high or low multiples, scrutinize the details. Was there a unique factor like a distressed sale or a major strategic play driving the price? Breaking down these metrics helps you make a fair comparison and apply the results to the company you're analyzing. Think of it like assembling puzzle pieces. Each provides a part of the larger picture you need to see. By following these steps, starting with careful selection, meticulous data collection, and in-depth metrics analysis, you'll build a strong foundation for your valuation model. Common metrics used in Precedent Transactions Analysis. When analyzing precedent transactions, valuation metrics are essential for comparing deals and gauging a company's worth. These metrics simplify the complexity of financial data, offering a consistent way to assess past transactions and apply those benchmarks to current opportunities. Below, we'll break down some of the most widely used metrics and why they play a central role in the process. Enterprise value to EBITDA, EV, EBITDA. Enterprise value to EBITDA, EV, EBITDA, is one of the most common valuation multiples. It compares a company's enterprise value, EV, which reflects its total value, including debt, to its earnings before interest, taxes, depreciation, and amortization, EBITDA. Why is it important? This metric focuses on core operational performance, excluding the effects of financing decisions and accounting methods. It provides a clearer view of a company's profitability on an operational level, making it particularly useful when comparing businesses across different industries. For example, two companies might have similar net incomes, but one may have significantly more debt on its balance sheet. By analyzing EV, EBITDA, you can see through those differences and focus on the inherent value of the company. Analysts often use EV, EBITDA to identify patterns in deal pricing. If similar companies were acquired at an average of 10x EBITDA, this figure becomes a useful benchmark for valuing a new target. Price-to-earnings ratio, P/E. The price-to-earnings, P/E, ratio evaluates a company's value based on its stock price relative to its earnings per share, EPS. In the context of precedent transactions, it's used to assess how much buyers have historically paid for every dollar of earnings. How does this help in valuations? P/E ratios work well for companies with stable earnings and industries where net income is a key driver of value. They're particularly relevant when the acquirer focuses on long-term profitability rather than just revenue or operational leverage. For instance, a company in a mature industry like utilities might be valued based on its P/E ratio because its earnings are predictable. Meanwhile, a tech startup with inconsistent earnings may rely more on revenue multiples. However, relying solely on P/E ratios has drawbacks. Earnings can fluctuate due to one-time events or accounting strategies. That's why it's crucial to use P/E in conjunction with other metrics like EV, EBITDA for a well-rounded perspective. Revenue multiples. Revenue multiples, such as EV, revenue, compare a company's enterprise value to its total revenue. This metric is especially useful when companies have little to no profitability, as it sidesteps the need for earnings data in valuation. Why is this relevant? Revenue multiples shine in industries where growth takes precedence over profitability. For example, High-growth tech or SaaS companies might be valued on their ability to scale revenue quickly, even if they're not yet profitable. This metric is also useful for comparing companies with varying cost structures. Two businesses may have similar revenue figures but very different profit margins. By analyzing EV, revenue, analysts can focus solely on the top-line performance, ignoring variations in cost efficiency. That said, revenue multiples should be used cautiously. They don't account for profitability or operational efficiency, so pairing them with other metrics, like EV, EBITDA, paints a more comprehensive picture. These metrics, EV, EBITDA, P/E ratios, and revenue multiples, are the foundation of Precedent Transactions Analysis, guiding professionals in comparing and valuing businesses with consistency and precision. Each provides a unique lens for assessing opportunity, helping analysts make informed, data-driven decisions. Challenges and limitations of Precedent Transactions Analysis. Precedent Transactions Analysis is a valuable tool for valuing companies, but it's not without its challenges. While it provides a market-based perspective, limitations can arise from data inconsistencies, shifting market conditions, and contextual factors unique to each transaction. These obstacles can make it harder to draw precise conclusions or apply findings effectively. Data availability issues. Finding reliable historical transaction data is rarely straightforward, particularly in private or less regulated markets. Why? Not all deals are fully disclosed to the public, especially those involving private companies. The lack of transparency means key information, like purchase price, payment structure, and financial details of the target, is often incomplete. Consider private equity acquisitions or smaller M&A deals. Specifics about earnings, revenue, or deal multiples may be omitted entirely. This leaves analysts relying on estimates, which can water down the accuracy of results. Even public deals aren't guaranteed to come with full disclosure. While filings from public companies and databases like Bloomberg or CapIQ are helpful, they don't always present the full picture. Missing data points like earnouts or deferred payments can skew multiples or create blind spots. And let's not ignore data standardization. Metrics reported in one deal might not align with another. For example, one company may use adjusted EBITDA, excluding specific costs, while another sticks to GAAP standards. Reporting periods in the transactions might differ, adding inconsistencies. Ultimately, these gaps make it tough to build a fully comparable set of transactions. Analysts often have to make assumptions or adjustments, adding a layer of subjectivity to what should be a numbers-driven approach. Market conditions impact. Market conditions play a huge role in determining transaction values, but they're rarely consistent. The economic environment at the time of the deal can drastically influence pricing, which impacts how relevant past transactions are to current valuations. Let's say you're analyzing deals from 5 years ago. What was the state of the economy back then? If the M&A market was hot, valuation multiples were likely inflated. On the flip side, deals during economic downturns likely reflect discounted prices. Using these figures without adjusting for market conditions can create misleading results. Market volatility further complicates the issue. Consider industries that are prone to boom and bust cycles, like tech or oil and gas. A precedent set during a peak might overvalue a target, while one from a low point might undervalue it. Shifts in interest rates, regulatory changes, or new market trends can also make older transactions irrelevant. For example, a sudden spike in borrowing costs could depress buyer demand, pushing down valuations. A new regulation might impact the desirability of certain industries, shifting price expectations. Even broader shifts in buyer motivation, like increased interest in strategic synergies, can alter transaction terms. When times change, so do benchmarks. Analysts need to adjust their data interpretations carefully to reflect current conditions, rather than blindly applying old precedents. By acknowledging these challenges, analysts can approach precedent transactions analysis with a realistic outlook. It's not perfect, but understanding its limitations helps you use this tool more effectively. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.